Oh, 1999 was awesome. In 1999, you could start a company with no product, no profit, no real business plan, and as long as your name ended in .com, investors would throw millions of dollars at you. People were quitting their jobs to chase internet stocks. College kids were becoming paper millionaires. A new millionaire was created in Silicon Valley every 60 seconds. Then, in less than 3 years, $5 trillion disappeared. This is the story of the dot-com bubble, the greatest gold rush in modern history, and the moment the internet itself almost killed our entire economy. To understand how it happened, you have to go back to 1995. The internet was new, most people had never used it. If they had, it was through a screeching dial-up modem that took 2 minutes to load a single picture. But a few people saw the future. They understood that the internet was about to change everything. Shopping, banking, news, entertainment, all of it. And they were right. They just weren't right yet. In August of 1995, a company called Netscape went public. Netscape made the most popular web browser at the time. On its first day of trading, the stock more than doubled. The company was suddenly worth almost $3 billion. Here's the wild part. Netscape had barely made any money. It was actually losing money. But that doesn't matter. What mattered was the idea. The future was here. The internet was real. And if you didn't buy in now, you're going to miss it. That's the moment the bubble started. For the next 5 years, the stock market lost its mind. The NASDAQ, which is the stock exchange where the most tech companies are listed, went from about 750 points in 1995 to over 5,000 points by March of 2000. That's a 580% jump in 5 years. In 1999 alone, the NASDAQ nearly doubled. The rules of investing, they didn't matter. They didn't have to make sense. Normally, when you buy a stock in a company, you're betting that the company will make money. The more money it makes, the more your stock is worth. That's how it's supposed to work. But in the dot-com era, profits didn't matter. Revenue didn't matter. Sometimes the company didn't even need a finished product. All it needed was a website, a story about how the internet would change some old industry, and a name that ended in, you guessed it, .com. Investors weren't buying companies. They were buying tickets to a future. Just hasn't happened yet. Every week, a new startup would have its IPO, which is when a company first sells its stock to the public. And on day one, the stock would often double or triple. People were getting rich overnight, not because they built anything, just because they got there early. Want to see how crazy it got? Let me tell you about pets.com. Pets.com had a simple idea. They were going to sell pet food and supplies online. Bags of dog food, cat litter, chew toys, all delivered to your door. It sounds normal today. Chewy and Amazon do it all the time. But in 1999, this was a revolution, and investors loved it. Pets.com raised over $80 million in its IPO in February of 2000. They had a famous sock puppet mascot that went on talk shows and in the Macy's Thanksgiving Day Parade. They paid over $1 million for a 30-second Super Bowl commercial. Here is the problem. In their first 9 months as a public company, Pets.com lost $147 million. The Super Bowl ad alone cost more than the company had ever earned in its entire history. Why? Because the math didn't work. Shipping a 40-pound bag of dog food across the country costs a lot of money. Pets.com was charging customers less than what the shipping actually cost. They were losing money on every single order. The more they sold, the more they lost. Nobody cared. The stock was going up. The puppet was on TV. The dream was alive. From IPO to total shutdown, Pets.com lasted 268 days, less than 9 months. The stock that opened at $11 sold for 19 cents at the end. And Pets.com wasn't the worst. A company called Webvan, which delivered groceries, burned through $830 million before it went bankrupt. There was a company called Boo.com that spent $135 million in 18 months trying to sell designer clothes online before totally collapsing. There was a pattern. Take a real-world business, add the word online or .com to the end, raise hundreds of millions of dollars, spend it all on Super Bowl ads and free shipping, and then disappear. By early 2000, the smartest people on Wall Street started to whisper the truth. These companies weren't worth anything. The numbers didn't work. The party had to end sometime. That sometime came on March 10th, 2000. NASDAQ hit an all-time high of 5,048 points. It would not see that level again for 15 years. The crash didn't happen all at once. At first, it was a slow leak. Few percentage points down here, a few percentage points there. People told themselves it was just a normal pullback. The internet was still the future. Stocks would bounce back. Then came April 14th, 2000. In a single day, the NASDAQ dropped almost 10%. It was the biggest one-day percentage drop the index had ever seen up to that point. That week, NASDAQ lost 25% of its value in 5 trading days. The bubble seemed to be popping. But once it started, didn't stop. Over the next 2.5 years, the NASDAQ fell from over 5,000 points to about 1,100. 78% drop. About 5 trillion in market value disappeared. Not millions, not billions, trillion, 5 trillion. To put that in perspective, that was more money than the entire economy of Japan at the time. Just gone. Here's what made that crash so painful. It wasn't just that bad companies failed. Almost every internet company got crushed. Amazon stock fell from about $100 a share down to $7. Yes, the same Amazon that's worth trillions today lost over 90% of its value. People who had bet on Amazon thought they were going to lose everything. Cisco, which makes the equipment that runs the internet, had at one point been the most valuable company in the world. Its stock fell almost 90%. And the companies that didn't have real businesses, gone. They're just wiped out, boarded up, sold for scraps, if anything. Office buildings in Silicon Valley sat empty. Programmers who had been earning huge salaries were suddenly looking for work. The 21-year-old CEOs who had been on magazine covers were now hiding from their investors. The dream of getting rich overnight on internet stocks ended the way most dreams like that end, with a hard wake-up call. So what's the lesson here? For investors, the lesson was as old as the stock market itself. If a company doesn't make money, eventually the stock can't keep going up forever. Profits matter. Math matters. You can't ignore the basics just because a story sounds exciting. But here's a bigger lesson buried in the dot-com bust. The crazy part isn't that the bubble popped. The crazy part is that the believers were mostly right. The internet really did change everything. The future they were betting on really did happen. Online shopping, streaming video, social media, food delivery, dating apps, all of it became real. The internet became one of the biggest industries in the world. The believers were just way too early and way too willing to fund any business with a website, no matter how broken the math was underneath. Pets.com was wrong about timing, not the idea. Today, people buy pet food online all the time. Chewy is worth billions. Sock Puppet was right. Pets really can't drive. Webvan was wrong about timing. Today, online grocery delivery is a huge business. The dot-com bust didn't kill the internet. It just killed all the companies that were way ahead of the technology. And you're probably hearing echoes of this story in today's news. AI companies are raising billions of dollars at sky-high valuations. New tech IPOs are doubling on day one. Smart people are warning that we might be in another bubble. Maybe they're right. Maybe they're wrong. The truth is nobody knows what tomorrow's Pets.com looks like until after it crashes. But here's what we do know. Every few decades, investors fall in love with a new technology. They throw money at every company that sounds like it might be part of the future. Most of those companies fail. A small handful become the giants of the next era. The hard part isn't spotting the bubble. The hard part is figuring out which companies are the Amazon and which are the Pets.com. In March of 2000, they looked exactly the same. If you like this video, check out the resources I've linked down below to go a little bit deeper, and hit subscribe for more stories like this one. I'll catch you in the next video. Stay tuned.